To remain updated with the latest business news, click on the bell icon.
Welcome. You're watching Business Today. I'm Sakshi Batra. Well, is the recent stock market sell-off a good time to buy winners for the future? That's the question most of the investors are asking experts amid the ongoing uncertainties with this Russia-Ukraine conflict and also the emerging macro headwinds as well. I'm joined by a very special guest to discuss more insights on how does one really approach the future of their investment portfolio today. Joining in is Mr. Siddharth Khemka with me, Vice President, Head of Retail Research at Motilal Oswal Financial Services. Thank you so much, sir, for taking out time with us on this discussion. Let me kickstart by asking you, we have seen a bounce from the sharp fall that we've seen due to the conflict of Ukraine and Russia crisis and the war. But do you see this actually a reason why there has been some value buying leading to recovery? And also, will this recovery really sustain?
Yes, actually, very good afternoon, and thanks for having me on your show. So, if you look at the overall market setup in terms of valuations, we were quite reaching on the higher zone. So, basically, valuations were uncomfortable, and we were trading at a premium valuation because of the growth in the economy as well as in the corporate earnings post-pandemic. And people were looking for entry opportunities. And with the if you look before the Russia-Ukraine issues, the major issue that were there that was impacting the market was that of inflation and interest rate. We have seen the huge inflow of liquidity globally because of the, you can say in a way, artificially low interest rate environment globally set up by the central banks across the world. The response to the economic slowdown because of the pandemic.
Correct.
That helped create the kind of liquidity flows towards emerging markets, and India was a special recipient of a bulk of this liquidity. And last few months, since October, we have seen that the FIs have been pulling out not only of India but out of other emerging markets as well, in anticipation of the rate hike by especially by the US Fed, which is what is the benchmark that follows that other central banks across the world follow. So I think it's the correction, although unfortunate because of a war, but nonetheless it gives an opportunity for long-term investors, because wars don't last forever. War will get over in few days, few weeks. I'm not an expert on the geopolitical issues, but whenever it ends, things will go back to the focus of the market will go back to economic trends, the corporate earnings, for which I think bearing the a short-term impact because of the high crude oil prices, high energy prices, which has a potential to impact margins and costs for corporates across the world. But nonetheless, the underlying economic growth, which was fueled post-pandemic because of this huge spending by governments across the world, in India, because of the lower interest rates. That is something I think the economic cycle has started and would continue for over the next 3-4 years.
Right. So what is the best way for investors to really deal with this risk off? And in terms of portfolio strategy also, do you think the current macros and geopolitical moves warrant that it is time to perhaps relook at churning one's portfolio?
So any global development definitely needs to triggers a relook at one's portfolio. We are in a very dynamic world, and we should have a relook. Definitely in this environment, there are certain changes. As we discussed, energy prices are going up. So there are a lot of sectors which will get directly impacted. So there, if one has a preferred pick, can gradually accumulate over a period of time. There is no hurry. There are certain sectors which does not have much of impact, and things will go back to normal very fast, very quickly. And those are the stocks where one could look at in the immediate near future to start accumulating on an aggressive basis.
Right. In particular, are you looking at some of the sectors that may turn out to be winners in 2022, which is largely being seen as a year of consolidation, perhaps, full of volatility, perhaps, for the stock markets? So what is the best way to deal with this kind of a volatility and uncertain environment and still be able to, perform better or relatively stay in profits amidst this consolidation scenario in 2022?
Yeah, Sakshi. So you look at sectors and stocks which are doing well. One is to look at domestically focused companies. Say, for example, we are very positive on the real estate space, which is entirely focused on the domestic markets. There's no impact from the global volatility. The sector has seen a kind of demand uptick after almost a decade. So we believe that the real estate cycle is poised for an upcycle after almost a decade, led by increase in demand, low interest rates, and the balance sheets and the financials of some of these corporate real estate players have become very strong after the regulation brought in RERA, GST, and the consolidation that we have seen in the real estate space. Furthermore, there's not much of impact from the energy crude oil prices for them. So I think that's a space which has seen correction in the current environment, but nonetheless looks good from a domestic market investment perspective. The other sector is, if you look at from a global perspective, IT as a space has seen correction over the last couple of weeks, and that is another space where we don't see any slowdown in the demand. We have seen quarter after quarter, last 2-3 quarters, the company is reporting strong deal wins. So the pipeline is pretty strong, and with the global volatility, the rupee has also kind of weakened, which is kind of positive in terms of margins for these companies. So in terms of risk reward, again, looks very favorable if one looks at the IT space in the current environment.
Right, absolutely. So real estate and IT sectors could be promising going forward from here. In case you're looking to add some quality names, definitely keep these two sectors on your radar. Let's also see some of the stocks that have actually slipped about 20, 30, even up to 50% in the recent fall that we've seen in the stock markets. You have the likes of ICICI Prudential Life. Then from the metal names, it's Jindal Steel, Tata Steel also slipping about 30% odd. You have the likes of IT space stocks like Bigwig, HCL Technologies, Tech Mahindra, both of them down by almost 20% at this point in time, even till 30% of all that you've seen in this quality IT names. Some of the cement majors, Ultratech Cement, Godrej Consumer, which was actually a good performer in one of the few months that we've seen really in the recent past, but that has also slipped in trade. DLF from the real estate basket has slipped as well. How are you looking at this basket of names that have actually come off their 52-week highs almost by 30 to 50% odd? And should one really look for some buying opportunity, value buying opportunity in these, or will it be like catching a falling knife?
Yeah, Sakshi. So if you look at these names that you've taken, it's an interesting set of names and from varied sectors. So, for example, some of the insurance names have corrected. There is a big overhang of the LIC IPO. It's one of the largest IPO that we are going to see. So I think people are moving out of some of the other insurance names, and so we have seen the business being impacted after pandemic. So the core business growth is not there. The overhang of LIC IPO, I think insurance could remain under pressure. Similarly, if you look at some of the FMCG space, there's a huge raw material cost pressure. Further with Russia-Ukraine issue, I think so you have cost escalation in palm oil, you have cost escalation in wheat. So these are, I think they will continue to remain under pressure. Some of the interesting names that one can look at, maybe look at them after correction of 20 to 30%, they looks like some risk reward is favorable. So as we said, within the real estate pack, one can look at DLF. The stock is down almost 30%. You can look at some of the IT names, HCL Tech Mahindra. From the larger ones, even Infosys is down about 10-12%. So you can look at those names. Cement is another space where there is a pressure because of the increased fuel cost. But we believe that because of the government spending on the infra space, the budget had capex written all over it, plus the residential real estate space seeing good demand and growth. I think cement will do well. So Ultratech is another stock which has seen correction, but one can definitely add to their long-term portfolio.
Okay, I understood that. Now let's also look at some of the stocks which have actually not really fallen in this massive crash that we've seen in the stock markets over the last few days. And some of the stocks have really been resilient. Talk about stocks like Titan, for example, or Escorts. These are the names that most of us have always kept on talking about the earnings perspective. And you have seen them to be quite resilient. at this point in time. Some of the new energy stocks, Linde India, Adani Transmission, keep an eye out on Hitachi Energy as well. Stocks from the healthcare space like Narayana Hrudayalaya, or even other stocks which have been performing very well in the stock markets over periods and cycles as well, like Page Industries. So how do you look at some of these names at this point in time, some of those which have not really got affected with the overall market crash? Is it better to look for some stocks which can actually provide you stability in your portfolio for the long term and weather the kind of shocks that we see time and again, and something which analysts and markets also cannot predict?
So Sakshi, again, another interesting set of names. Very interesting to see some of the energy names, some of the metal names, and some of the consumer focused companies. So if you look at ideally, one would have not thought that these kind of names could have come together as a stable stocks in this environment. But as I said, this event is different. This is not a normal economic global event. It's a war-like situation, and especially involving one of the largest exporters of oil and gas, that is Russia. So I think there are a lot of players which are benefiting. So for example, aluminium, Russia is a large supplier globally, and that is a space that has kind of getting impacted because of the sanctions. While the US have still steered away of putting any sanctions on energy exports out of Russia, but the other products are getting impacted, and hence we are seeing that consistent performance from some of the aluminium names, for example, Hindalco, Nalco, and they have outperformed the other metal names. You saw Tata Steel and some of the other steel names in this list, the previous basket that we discussed, which were down 20 to 30%. But Hindalco is here in the top list. I think that aluminium companies will do well. There's a good demand globally. There is a supply shortage that is going to happen out of Russia. And Hindalco having a global presence and plus a subsidiary in Europe, which will also help gain that market share, plus strong prices. If you look at some of the domestic names, again, domestic consumer names, in times of these volatility, these are the stocks or sectors that do well. So for example, Page Industries, Titan, they're not the regular consumer staples and not the regular consumer durables. These are special category market leaders in their respective spaces, doing pretty well. And specifically, if you look at Titan, consistently they have delivered on their growth. Although last year they got impacted because of the pandemic. There are not much weddings that could happen, low-key weddings that were happening. So that got impacted, but they've now come out of it and we're seeing huge demand. They're also benefiting because there is a rush to buy jewelry, as we are seeing that because of the war-like situation, gold prices are going up and people want already planned their weddings. They don't want to, they just want to rush in and buy those jewelries before the price rises. So that benefit is being taken by Titan. We are seeing that clearly. So I think these stocks will remain strong in the near term. And if you see the long-term growth visibility, they're consistently delivering growth and expected to remain so. So these stocks do merit to have in one's portfolio, Titan and Hindalco.
Okay, understood that as well. In terms of asset allocation, I wanted to ask you, in the year 2022, how are you going to deploy the funds that you have right now amid the large, mid and small caps at this point in time? You've spoken about sectors and specific stocks that one can definitely look at, but you talked about gold as well and how gold has been rising in this uncertain, scenario as well. How does one really, it's the importance of asset allocation really emerges even more in such uncertain times. So help us understand, how are you advising clients at this point in time?
Yeah, Sakshi. So very important point, especially in this volatile environment, to have the right asset allocation. I would say that within equity, if one were to look at, the year is going to remain a bit kind of challenging with volatility likely to remain. The war-like situation, as we discussed, may be over within the next 15-20 days. But then the biggest challenge would be the US Fed rate hike that would go on throughout the year, and which could keep the market a bit volatile, and hence don't expect very huge returns. And in this kind of environment, the small caps and mid caps generally do not do that well. So I would say that in this environment, one should largely remain focused on large caps. So 50 to 60% of the portfolio should be focused towards large cap blue chip stocks. and the correction will give or is giving us good entry opportunity. Some of these names we have already discussed some of them. Another 20-30% one can remain in mid caps. Again, selectively, one can look at sectors and stocks. There are several market leaders which are there, which are not present in the large caps, which you can play only through mid caps. So those are the names which will do well, and you can focus on that. Another 10-15% at least one can have. I would say not more than 10-15% in mid caps or some of the new age stocks that one can participate in.
Okay, understood that as well. So the year might not give you handsome returns like we've seen in the past 2 years, but there is definitely a way how you can protect your portfolio and your capital and your investments and yet be able to get handsome returns as well. And Siddharth has shared very well the way you should be deploying cash in the year amidst the large, mid and small caps at this point in time, how to choose some specific sectors that may definitely perform better than the others in this year, and specific stocks that you can look at for providing stability and also returns onto your portfolio at this point in time. Thank you so much, Siddharth. Always a pleasure having you with us on Business Today. And thank you for sharing these wonderful insights with our viewers.
Thank you. My pleasure.
If you like the video, do like, comment, share and subscribe.